Hi guys, welcome to T Account, a platform for educational videos for students and accountants. We started from financial accounting for ACCA and now we are on chapter 9, intangible assets. Intangible assets are non-current assets which don't have any physical existence or physical substance, form, nature. We have briefly covered this in the previous discussion of non-current assets, but here we'll go in more details. In this video, we'll be covering definition of intangible assets, main characteristics, how to account for, how to recognize these assets, and more focus is according to this syllabus on Goodwill, research and development expenses, and how to account for those things. Starting from the definition given by the standard 38, International Accounting Standard 38, intangible assets. Its intangible asset is an identifiable non-monetary asset which lacks any physical substance or form. An identifiable non-monetary asset without physical substance. Okay. Now, from this definition, if you see, we already discussed and in detail we discussed the elements of financial statements in a previous lecture where we defined assets. Okay, the definition says this is an asset. Asset, to be an asset, it needs to be a resource controlled by the entity. Resource controlled by the entity and from which economic benefits, future economic benefits are expected. So, first characteristic is being an asset, it needs to be a resource controlled by the entity. Secondly, it's an asset without physical substance. It doesn't have any physical form, nature, something like that. Like this board you can see and touch. This is something tangible. But intangible assets like trademarks, brands, customer lists, patents, copyrights, these things you cannot touch and see. But they may be having high and substantial values. So, no physical substance. And the third main characteristic is it is identifiable and separately distinguishable from goodwill. If an intangible asset is not separately identifiable from goodwill, it is just a part of goodwill. You cannot separately recognize it. Separately identifiable means if you have some asset and you can dispose it off independently, separately, so sell it off or you can license it, use it separately, independently, so you can, then it will meet this definition of identifiable, separately identifiable asset. So these are the three main characteristics to be an asset. Then we come to the recognition. To recognize an intangible asset, first it needs to meet this definition. Once this definition has been met, the second thing is whether this is the cost of this asset is reliably measurable. If you can reliably measure the cost and the future economic benefits are probable, you can prove that, yeah, we'll be getting the future economic benefits. For instance, you have paid and it's been registered in your name, your company name, I mean. So you will be meeting this criteria. Definition, then reliable measurement of cost and probability of future economic benefits. Then you can recognize this asset. Now, goodwill. Goodwill is commonly, seen on statement of financial position. What is goodwill? Goodwill is basically something, you purchase a business and you pay for that, you have, whatever you pay over and above the net assets, the value of net assets that you are buying, whatever you are paying in excess of that value, that is goodwill. Simple, let's put it in simple words. For instance, you purchased a business for which net assets, total net assets are worth $20 million. Okay, you paid $30 million. $10 million is your goodwill. Now the question is, why you are paying 10 million more, whereas you are buying building, machinery, furniture, whatever they have, motor vehicles, whatever they have, total is worth 20 million, but you are paying 30 million. This 10 million is for the, you can say, reputation of the business, or the business is already successful and running, generating profits. So you are going to buy that business. So this is basically for that. They may have spent a lot of money on marketing, advertisement, publicity, and the customers now know that this is the place to buy these things. So you are paying for that stuff, this extra, which is called goodwill. Now this is where you purchase a business. Purchased goodwill you can straight away recognize, account for. Whatever you pay in, you are paying in excess of these net assets, you can recognize it as an intangible asset, goodwill, on your statement of financial position. However, when you are running a business, you also may have generated a big amount of goodwill, meaning your net assets, the value of your business is much more than your net assets, and you have a goodwill of millions, but you cannot recognize it. That is internally generated goodwill. You cannot recognize it. IAS 38 doesn't permit the internally generated intangible assets, because you are not sure how much you are going to get for that unless and until you dispose of your business. Okay, then you will be realizing that goodwill, but until then you cannot recognize it. Okay, this is about definition and goodwill. More detail we need for this syllabus, we need to discuss in more detail the research and development expense. Guys, this research and development expenditure, the definition given by the standard, I have written so that we can easily discuss it. An original and planned investigation undertaken to, find out, with the prospect of gaining new scientific or technical knowledge, okay, and understanding. Whereas the development is the application of that knowledge or some other knowledge to a plan or design for the production of a new product, or design for the production of a new or substantially improved materials, products, systems, processes, whatever. I have cut it short. Before the start of commercial production, just before the start of commercial production, you are making some design or prototype for the actual product. So you are those. Now, from this definition, being an accountant, the main issue for us is whether to recognize these things, because on this research and development, the company spent millions and millions of dollars. Whether we can account for this amount as an intangible asset or write it off, that's our question. Because even for this expense research, their intention is to generate revenues, finally discover something and earn a lot of money. Same is the case here. Now, whether to recognize it or not, that is the question for an accountant. As a rule, standard says write it off. Research, charge it to the profit and loss account. Why? You need to understand the logic as well, because this is something you are looking for. You are spending a lot of money in looking for some result or some new product, but that is some uncharted territory where you are going. You are not sure about the results. You are looking for something, you might get a very good result, great breakthrough, but you may not find anything. You may totally fail in that adventure and lose a lot of money. So here, too much uncertainty. Things are not that clear. Probability is very, unclear. So this, being an accountant, because accountants are prudent, cautious, conservative. So this sort of, in that kind of circumstances, they cannot recognize it as an asset. So charge this to the profit and loss account, income statement. However, when you come to the development stage, things are quite clear. You have already done your research and your results are with you. You know the product and you know how to produce and how to generate revenues from it. You can demonstrate all this. So this is quite advanced level from the research stage. So whatever you are spending here on the development of some new product, you can capitalize it provided you meet the criteria. We'll discuss the criteria as well. But here you can account for, because the things are quite clear, products are there, you can demonstrate how you will get generate revenues from that product. So this is the difference between these two. Now in questions, I hope they will not ask you for that, apply that criteria, whether the company is meeting that recognition criteria or not. But you should be able to identify on which stage the company is currently spending, whether they are spending on research or development. If development, then the examiner will tell you whether they have met that criteria or not. If they are meeting that criteria, you can recognize it as an intangible asset, development costs. Remember, internally generated intangible assets are not recognized as a general rule. But this development cost, if it meets all that criteria, you can recognize it. Okay, now what is that criteria? Okay, as I said, for to recognize development costs as an intangible assets, you need to demonstrate, you need to prove that you are meeting the criteria for recognition. Big lengthy criteria. It's not that easy, because internally generated intangible assets are not recognized. You cannot recognize, you are not allowed. But this is an exception. But there is a big criteria to meet. Ability to use or sell the asset. If you can produce whatever you are developing, but you cannot prove that there is a market where you can sell it, so you are not meeting this criteria. You need to prove that you can sell. You have an active market or other sources, a place where you can sell it. Ability to measure reliably the expenditure, because expenditure was too late, so I got confused. Ability to measure reliably the expenditure on the intangible assets. Like any other assets, if you cannot measure the cost reliably, no recognition. Remember, reliability, calculation of cost and reliable measurement is very important characteristic for recognizing any asset or even that liability. Intention to complete the intangible asset. management will have to prove that they intend to complete it. Otherwise, they cannot, keep this cost in their statement of financial position. In later stages in maybe financial reporting that is subject on more advanced level, you will be tested on that as well. How management can prove, and from the scenario you need to identify or assess whether management is meeting this condition or not. Intention to complete the intangible asset. If they don't have a clear intention, write it off. Technical feasibility of completing the asset. If it is technically not feasible, there is some hurdle which can prove that this is not possible. Technically, this is not possible, or you cannot do it. Not feasible. No recognition. Overall probable of future economic benefits. You will have to prove the viability of the project. If you produce new product, very good, but at the end when you go for commercial production and you sell it in the market, it's not viable. The costs are higher than the revenues you are expecting from it. No recognition. So overall probable future economic benefits. The availability of technical, financial and other resources. The availability of technical, financial and other resources to complete the development. If you don't have competent people who have the required skills and knowledge to complete it, you cannot demonstrate this factor. Or you don't have financial resources, you have liquidity crisis and you cannot, you are not meeting your debt servicing or other liabilities. Auditors might say, but this is, I'm going in more detail, but briefly, if you are lacking any of these resources, financial, technical or any other resources to complete the development, no recognition. And even if you have recognized, you are meeting all this, and later on it is found that now you are not meeting any of these criteria any longer, you need to write it off, charge it to the profit and loss account. Otherwise, recognize it. If you are meeting this criteria, recognize development cost as an intangible asset. And as soon as the commercial production starts, you need to amortize it. Like any other intangible assets, if they have a finite life, then you need to, like trademarks of your own company, they don't have a finite life. They will continue with your company whenever, as long as you are going concern. So for those sort of intangible assets, you are not required to amortize. But all other intangible assets, they have limited life. Whatever the life they have, 10 years, 20 years, 15 years, whatever, you need to amortize it on that period. Again, the amortization method will depend on the pattern or economic benefits you are going to get from this asset. But if you cannot, reliably see the pattern, you can adopt that straight line, which is the simple method. Just amortize it over the life of the asset. Total cost of development divided by the number of years over the period over which you are going to utilize this asset. So that's how we deal with these things. Brief recap. Research, no recognition, no capitalization. As soon as you spend that money, charge it to the profit and loss account. Clear. Development cost. if meets this criteria, recognize it and amortize it over the useful life. Initial recognition is always cost, whatever you are incurring, but later on amortize it, and the net book value will be the value on which it will be presented or carried in the statement of financial position. It is, intangible assets are carried on cost, less accumulated amortization. And but companies have an option to choose the revaluation model as well, but that will be very difficult, very hard, because for that you need to have active market for that intangible asset, so that you can find the fair value of that asset, which is very rare, quite rare. You cannot, almost impossible. But if you find that active market, you can carry it on revaluation model as well, as we discussed in the non-current assets cost and revaluation model. So normally it's carried on cost. This is intangible assets. We already covered the tangible assets, non-current assets as well in the previous videos. Hopefully it will be very helpful for you, and if you have any questions, comment. If you are interested in the previous videos, I'll give the link in the description. Thanks a lot for watching. Thanks.